figure out a way to come back, remain stoic, keep a smile on your face, and know you're going to figure it out one way or the other, come hell or high water. The market is out to make money. It's not out to give it away. And so you have to protect your downside before you shoot for the $1 million.
Sitting on today with Jean-François Boucher, we didn't have a talk in a while about scalping in the market, so we thought it would be good to bring him back with this new year, kind of discuss about what he's doing in scalping and a bit more about how you can use it to fund your lifestyle. So good to sit down and look forward to see what you got for us today.
This is the end of the year. It's the end of the quarter. It's the end of the month coming up in about 2 weeks. It's the end of 2025, so it's a good time to go back and review, and if required, maybe even reset going forward. And so a couple of days ago, I was hosting another training session with the group, and we reviewed a couple of slides. And so it was a good reminder for today's session, looking at the month of November. In this current account, we managed to extract from the market about $5,500. And then if I look at the current week, so going from November to December, the current week is up about $1,000. If I look at from the current week to today I made about $600. And as we speak, there's still a float of about $875 between the current price and where my break even is. And so a lot of the strategy revolves around targeting that white line. So when you feel the heat coming down, when you think your trade may have been compromised and you'll want a quick exit, instead of looking for the price to reach the actual target, you sometimes are better off just exiting at break even and neglecting the rest. Just forgive it and move on. And so the idea of that white line is what we try to control, right? We have 16 clicks. The intent when we start is not to use all 16, right? We want to use as few as possible, but we're allowed to use 16 if required. And it's not willy-nilly. It's distributed over time based on, price action, like we saw here this morning during our normal 2-hour trading session, right? So during our 2-hour session this morning, we assumed a bullish bias based on what we saw on the daily candle. And so I started buying, testing for support. And we bought on that green candle here and made money hours later, right? So we tested support. The assumption was correct only hours later, right? So ideally, I would have bounced immediately into 3 pips. What happened is our test of support, although it was right in the long term, was wrong in the short term. And so that forced me to use click number 2 and click number 3 and click number 4, 5, 6, 7. Ultimately, I think I clicked 8. There's 2 on top of each other here. And so I managed to squeeze in 8 clicks in 3 boxes. Ultimately, I avoided using all 16 clicks. The move that I was looking for, the bounce off of support, came in off of support from over here.
Just want to maybe make clear for people, like a lot of people think that when you add click, you're just adding risk to your trades. You actually like using risk in a very smart manner. Do you want to kind of walk through how you use risk for those trades?
Yeah. So those 16 clicks, I forget not everybody is familiar with the thesis. The 16 clicks are made up of small individual trades. And each individual trade is 0.25%. And so the idea behind this strategy is we're measuring a current move. So when I started, I was measuring from the high down to where we were. And this happened to have been about 3 boxes. And so I'm expecting 0.25% per click and I'm expecting to put 4 clicks per box. So I already measured when I started a 3-box move. And going forward, I'm now thinking I'm willing to spend up to 4 clicks per box, up to 4 boxes worth, in order to find the bottom of this move here. Right. So I'm willing to play another 4 boxes below when I started. So 16 clicks worth. Had it fall in 4 boxes, I would have spent 16 clicks. It only fell 2 boxes and I only used 8 clicks. So in total, I spent 2% of my account to build this position right here between this red line and this low down here. So I started on the red line, 10 o'clock Eastern. I started layering a position. I'm willing to use up to 16 clicks. And today I was only required to use 8. And the move that I was looking for eventually showed up. Right? Support was located right on the inside swing. Right? So if this had failed to support, we would have been testing the outside swing with maybe 4 more clicks. And then if that had failed, we would have been last attempt looking for 4 more clicks in here. Right? So ultimately what we're doing is we're targeting the next move. We know we're in the right ballpark. We're just trying to use as fewer clicks as possible or as fewer clicks as required to find the bounce that we're expecting. Right? So it's kind of, we know we're in the right area. We know what should be coming here based on time of day and our top-down analysis. And because of that, we're distributing some risk to find that next move. That next move is our postponed gratification, right? That's when we get paid. And so you can see here this morning, I had 8 clicks. They closed partially here. Some of them closed. And I ended up reopening some of them on the way up. So I managed to keep 8 clicks open after 8 clicks were already closed. And here I am now holding 8 clicks that are pending the target. Right? So for how many minutes now? Since I finished trading my 2-hour session, I've had 8 clicks open for 497 minutes, waiting to get about 14 pips away from where we are right now. All right, so we've been going sideways. Oh, this box is the wrong size. We've been going sideways for 1, 2, 3, 4, 5, 6, 7, 8. If we push everything properly, it's 8 hours. And so we're now waiting for a break out of this range. Clearly, we're in a range, right? We're just going sideways. And we're waiting for this next move up. Okay, so as the price retraces back to where we came from, hopefully, it will gratify the trades that have been open earlier.
What's telling you that the price will go up from there? Like, what's the indication that it will go up and not down from there?
Well, the probability remains open from this morning, right? So I started with my top-down analysis this morning. Ignore the green candle; it wasn't there yet. Right. So this morning, when I started at 10 o'clock Eastern, the daily candle was still green and we were hovering around here somewhere. And I suspected we were testing for support in this zone. And so I started buying on the way down and tested for support is what happened. Support came about and we bounced from this low to where this green candle opened. Right? So the long that I was shooting for was from here to there. It gave us 16 pips. And that 16 pips, if you come back tomorrow and look at this daily candle, this will either have been a wick or it will have been swallowed up by the daily candle. And so the 16 pip move that we've just experienced right here, I'm kind of hoping extends a little bit further to pay out these trades that I opened this morning on the way up. Right? So the trades that are remaining were opened right here on this up leg. And if we hold support, which we have once, twice, 3 times, we seem to be heading in the right direction. And so if push comes to shove, if I feel compromised, I'll just take my 36 pip ejection seats and tighten them up so I don't end up losing 36 across 8 trades. Right? So every click I take starts out with this ejection seat built in. Right? So now I'm just tightening up all of the stops for all 8 trades to the previous or to the most recent swing low. Right? So I'm kind of hiding my stops behind the swing. And if it keeps going up, I'll be closing the trades in the money. If it comes back down, it may or may not threaten my stops. We'll see. Right? But ideally, what we've done just now is reduce the risk that we're exposed to. Right? So it's not abnormal that I trade counter trend, but it's not my main objective. Right? So when everybody sees red, 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 and then you watch me buy, it brings about a lot of inquiries. A lot of people want to know why. And if you go back and look here, it's kind of self-explanatory. The very first trade, or actually perfect example right here. It's a down leg. And I already, from my top-down analysis, figured out I wanted to be a buyer. And so right here might be support. And as the price approaches that support, as a buyer, I want to buy support. And so here I am buying a green candle in a down leg, right? I should have bought the red candle before, which I did, right? But ideally, this right here should have been right there on that red candle. And that would have paid me out on the green candle. What you see here is me being late 30 seconds or so and getting paid the next candle over. Right? So this one trade right here should have been one candle earlier and closed on that first green candle. Hence, we buy the red on support. Let's see if there's another one right here. Right? So right around here, right here, we tested resistance on the way up. We tested it again as support on the way down. And I bought it when this was a red candle and it closed on itself when the red candle turned green. And so we're buying because it's the best price in order for the bounce. Okay, so most folks will wait for that confirmation. I'm trading ahead of the confirmation. I'm trading the probability. Okay, so ideally, when things flow well, maybe if I go back to current week, I think on Tuesday, I booked some losses. Right? So on Tuesday, same idea. When I started at 8 o'clock, similar concept. I was bullish and I wanted to buy support. And here, support failed. And I'd already determined where my risk was going to be. I'd already assumed where my risk was. And at the time, in front of the group, we told ourselves the risk was going to be below this low over here. Sorry, I didn't want that. Risk was going to be below this low right there. And so as we're trading, we're buying support, buying support, buying support, buying support. So we're buying red candles off of support areas. And what we assume on the left was resistance in the past. We're testing it as support over here. And then lo and behold, because of the ADR, how much we had already done in previous 16 hours. So I trade the top of the daily candle, the remaining 8 hours of the day. When we looked at the ADR right here at 10 o'clock Eastern, it had already been fulfilled. The average daily candle was already at its full average. And so I started to doubt my buying the top of the candle. I started thinking, okay, it's the probability of it going further than its average is limited. And so I said to myself, it's probably not good if we revisit this previous range. And so we called it in front of the group, right? If we make a lower low below this, so we're now inside of this. We're now inside of this previous range. Right? If we go below this, we probably don't want to be long anymore and start aiming for shorts instead. And sure enough, we played the long side, played the long side, and then a bunch of red candles showed up, boom, 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 took us below the low, and we closed all the longs remaining manually. That day ended up putting me in the hole about $900. Eight trades closed at 12 pips. I guess we can probably see it here, right here. All right, so all these trades at once, closing all at once. This is what we ended up with, right? Booking losses, boom, 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 boom. But immediately thereafter, when I came back to work on Thursday, actually I did a little bit more that afternoon, but when I came back on Thursday, we just continued with 3 pips, 3 pips, 3 pips. Right? So no revenge, no glory trade, no swinging for the fence post, nothing fancy. And you just, if you fall off the horse, you just get back on the horse and you continue to trade. Moral of the story is your job is not to recover losses, right? Your job is to recover your discipline, right? And consistency will return when execution is respected. Right? So if you go back to your model, go back to your plan, go back to your original strategy or thesis, stick to what you know works, make 3 pips at a time, if that's what your model says, and you'll be back on track in no time. Right? So we booked losses on Tuesday, and the week remains solid green. Right? So I'm not too compromised. You have to let go of that losing balloon and move forward with your life. The balloon's gone. Forget it.
The mindset that you come into the next day after a loss is kind of hard for people. Like if you have lost trades that day, then you come in the next day, you almost want to kind of change the target. So you want to risk more. You want to try to get back on track. Like that kind of mindset is very tough to avoid.
Yeah. And psychology that drives this, usually if you get out of bed and you think today is going to be just, a nightmare like yesterday was and the day before, if you think every day is a nightmare, today will become a nightmare. And so if yesterday was a nightmare, don't think about it today. Let it go. Let go of the balloon. You're only losing pips, right? The problem is you're attached to those pips because to you it means dollars and cents. And in reality, it's what brought you here in the first place. So instantly that loss makes you feel like a failure. That's what brought you here, to make money, but apparently I can't make money, so I'm a big loser. No, it's not you. It's the market doing its job. You just happen to be the target. You're either at the table or on the menu. You're on the menu, my friend. Right? Figure out a way to come back, remain stoic, keep a smile on your face, and know you're going to figure it out one way or the other, come hell or high water. The market is out to make money. It's not out to give it away. And so you have to protect your downside before you shoot for the $1 million. And clearly we're doing that here, 3 pips at a time, right? We're learning to layer in, we're learning to layer out, we're learning to start with a worst case scenario called an ejection seat, and we're learning to manage within that 36 pip space that we're managing. So each trade has its own 36 pip space. Right. So ultimately, we put ourselves in the ballpark to find that move, which should, theoretically speaking, happen, because we've measured from the left. We have an expectancy from that measurement that drives our behavior. Okay. So the top-down analysis is not the end-all be-all. It just, narrows the field of view. You may still have to change your mind halfway through the day, just like we did on Tuesday. Right? Instead of continuing to trade after losing $900, I just called it quits. I said, enough is enough. It's the end of my 2-hour window. I'm not going to overtrade. I'm not going to overcommit. I'm not going to get angry or get upset. I just walked away with a $900 hole in my pocket. And today, if we look at today, what did we do today? Today, I booked 600 and I'm floating. Where are we now? Did we retrace? Yeah. So we've retraced a little bit. Right. And so now I'm floating about 1,200. If we come all the way down here, my 8 trades will be closed and today will be another losing day. Right. But I'm protecting my downside. The account will not be at risk any further than this. And that's ideal. That's our job, is to manage drawdown, manage losses, let the profits take care of themselves. Right? The whole purpose for you coming to trade years ago is to make money. So I already know you're here to make money. The market knows you're here to make money. Everybody knows except you, apparently. Stop chasing the money. That's what you're here for. Chase the losses that take the money away. Learn to cut them off. Learn to mitigate. Learn to recognize the damage as it's unfolding. Right? So you already know, if we go below this low over here, that's 3 times we've tested this level. Let me put them right below the low. And then if we break those 3 attempts, I want nothing to do with longs anymore. So I'm just realigning the boxes so we can measure from this swing high, where's the market trying to go, right? So mathematically, this makes perfect sense. The market moving a full box is not out of the ordinary. We see it all the time, right? At the bottom of the box, as a bullish trader, I would expect a bounce. If I don't get a bounce at the bottom of the box, being that it's a measured move, I would expect, therefore, at the next measured move. That then makes it 2 standard deviations. It's like a Bollinger Band. At the bottom of that 2 standard deviations, a bounce is highly expected. The probabilities start to increase. Right? If you go into the 3rd box, you're now past the middle of the Bollinger Band. You're now heading towards the lower half of the band. And if the 4th box is presented, you've now crossed from the top of the Bollinger Band through the middle, all the way to the bottom of the Bollinger Band. That's one way to look at it. Right? So the 4 boxes represents from the bottom to the top, or the top to the bottom, whichever way you want to look at it. We're just breaking it down into chunks. Right? And today tonight, I'm not willing to risk more than 1.5 boxes, even if it may test this low over here. Right? So sometimes it makes sense to put it below the extreme And sometimes it makes sense to put it where the structure tells you, like right here. Does that make sense? Right? These three lows here is what I don't want to see broken over here. Right? So that saves me, about 2 pips. It's nitpicking, but that's what managing drawdown is, right? Managing losses, managing the bad outcomes. I already I already put in the effort this morning to collect the profits. And because the way the thesis works, when my 2-hour window expires, I walk away with the trades remaining as is. I don't touch the ejection seat. I'm tightening it up here to show you what would happen. Uh, this is what we want to lose. We don't want to lose the ejection seat, right? But I'm fairly confident that I'll close my trades in profit before we test the low. And if we happen to test the low, then tomorrow I come in and I have a little bit of uh, obedience to practice. I have to practice following my rules, following my guidelines. No, get back on the horse and do it properly.
Now that it's the end of the year and starting out on a new year, what kind of reset do you tend to look at for traders and for yourself to kind of start the next year fresh on the right track?
Yes, good question. There's a whole host of things. If you look back to 2025, and if you go back through your journals, you know, if you go back and look back through your journals, I have this one. I have all of these ones over here. There's every time you made a mistake, you should have been documenting it. Not every time you lost. Sometimes you lose because the market says it's a loss. But when it's a loss due to you, when it's your fault, you should have been documenting that all along. Right? And then at the end of the year, you want to go back and kind of take ownership and maybe create a plan of action. Don't try to create it's not like New Year's resolutions, right? You don't want to address it like going to the gym because you're going to stop within the first week, right? So instead, it's more gradual. Maybe break it up in quarters, right? So the first quarter of the year, you may want to focus on discipline. Get back to basics, trading one micro lot per click, just doing it well from the very beginning, just for that first 3 months, especially if you had big hurdles during 2025. If you blew up a prop account in like November or December, right? You don't want to start the year all gung ho thinking that this year will be the year. Not unless you make effort. And the first thing to do is reset your mindset, right? Understand that you're in total control of what happens from this day forward. You can even write a contract with yourself. Some of the things you probably want to check, a self-diagnosis. It's a diagnostic, right? It's not a judgment tool. And one of the first things you probably want to do is, state your current affairs. What kind of drawdown do you have? What's your P&L for the last 30 days? Your average risk per trade, 0.25%. What kind of rule violations do you create for yourself? Do you cheat your system? Do you add a click or two when it's not supposed to? Do you break the rules? Do you start early? Do you finish late? Do you overtrade? All that stuff. And then what kind of emotional state are you in when you're trading? Are you upset? Are you fearful because you lost yesterday? All this stuff has to be accounted for. And you're trying to be up, positive, healthy, winning, all of the positive things in life. Right? That's what trading kind of brings out of you. Ultimately, you're going to end up giving to charity. Isn't that what it was supposed to do? That's what life is. You're supposed to be helping each other out, and you can't help each other unless you help yourself first. And that's begin by being honest. Where do you have issues, and then how do you address those issues? Because we all have different personalities, and so each one of us has the same issues, and we're going to have to address them independent of each other, our own way, based on our biases, our what we were brought up to be. Right. So some people are ego driven, some are fear based, some are revengeful traders, or some are analysts like engineers. Burnout, that's common. All right. You have to identify where you fit in this and address it from that point of view. And there's ways to do that. Right. For me, ego driven is still today what I'm fighting for. Right. I still have the need to be right. This is why I created this thesis for myself, because I could not handle losing swing trades. I still get upset, right? So I kind of put the swing trading on the side. I focus my bread and butter on what I know I can do successfully day in, day out with my eyes closed. And the swing trades then become cherries on top, right? And so there's a model here for each one of us. And to be honest, we all fit most of these models one way or the other. Like we all have a foot in each one, but we're dominant in one. So you have to figure out where your dominance is and address that properly, right? And the primary failure state that you operate from is one of these, right? So you have to understand where you stand, how you're behaving in general, right? And then this was number 2. Number 3 is right here. And then a discipline integrity check. And so you have to answer yes or no honestly. And you want to define risk before every trade, yes or no. Right? For me, it's automatic. It's 0.25 per click. And before every session, I define where my floor and my ceilings are. Right? Do I stop trading after my max loss? Yeah, I did that on Tuesday. Right? Do I follow the same rule after a loss? Yes, I did that on Thursday. Do I avoid changing stop losses midway? Unless I'm tightening, I won't touch it. The ejection seat never gets worse. Do I review my trades? The winners I don't really care for because it's just a high probability working out. The losers are the ones that fill up my journal. And you can see I've shown you I have a few journals filled. Can I sit out when the conditions are poor? Often, yes. But odds are I'll find an opportunity somewhere else. And so as an addict, as a day trader that's doing it successfully, opportunities are everywhere. You're going to have to limit yourself from taking trades. So over trading is still there. Hence the 2-hour window for the bread and butter. And then the opportunist in me kind of floats around the rest of the day. Section number 4, the emotional and behavioral awareness is really, looking inward. What kind of emotion shows up before or after you break your trades? You break your rules. What am I usually trying to avoid when you're hesitating? What are you trying to prove when you're forcing things? When the box says 4 clicks and you're putting 8 or 12 or 16 of them all in the same box, why are you trying to move the market? Right? And so all of this kind of stuff is a reflection on your train of thought at that time. What does a good trading day mean to you? Right? So if you followed all your rules and you still lost, you should be cheering because you followed all your rules, right? And it led you to lose on your terms, right? Within your limits. And so ultimately it leads you to the reset. What instruments will I focus on? So you're probably going to take away a few. A lot of guys have just way too much stuff going on their plates. Maybe you have too many accounts that you're trying to trade all at once. Maybe you have too many instruments, too many setups. Right? It's okay to have one or two or three setups on the go and have three or four or five or six on the side ready to go. Right? So the ones that are ready to go are plans. So you're creating plans, waiting for the price to come to those levels. Right? So you fill your time with trading activities, but not with your finger on the mouse. Right? So it's a different kind of trading. And then maybe your position size will be adjusted now that you're, focusing all of your efforts on discipline and not over trading. You can limit yourself to 0.25% per click. The rules that become non-negotiable immediately should be, not touching your stop loss, rule number one, that kind of stuff. What it is you're struggling the most with is what you should put on there. Right. And that's just the top of the heap. You don't want to go to the gym right on the first week in January, right? You want to spread things out a little bit. First quarter, deal with this. And then with the second quarter, maybe deal with, the progression from discipline. What should be the next step from there? Right? Your daily loss or your stop trading rules. Do you have any? And if you don't, make sure you do for 2026, because that's why you blew up the account in 2025. All right. And then the process-based metrics. What is it you're going to track, and not dollars and cents? All right. The apiary platform that I work with has a comment section where I get to pick and choose from a drop-down list, a emoticon, whether it's a happy face or a smiley face or an angry face. I get to document how I'm feeling with that trade. You should try and do something similar to that with your journals. I'm anxious. I'm greedy today. I'm whatever with this particular trade. And then when you review this stuff at the end of 2026, you'll have a much better understanding of where your problems are. Right. So the reminder that I talked about earlier is your job is not to recover losses. Your job is to recover your discipline. Go back to doing what you know works. Even Mark Douglas said it. Even if it means you're trading one share, one unit, one micro lot, and go back to the most basic of your thesis and your risk. Right. And then therefore consistency returns when execution is respected. And so that's what you do when you fall off the horse. You don't ask for a new horse, or you don't go strategy hopping. You get back and you continue what you know works. Right. And that's it. If you want to, you should sign it and date it and make it a contract with yourself. File it away and then come back to it in 3 months and see how you can reassess some of those slides. But yeah, it's absolutely doable, right? We have to put our emphasis on drawdown management always. And then for the majority of people, that brings with it revenge trading. And so revenge trading is really psychology, and a lot of traders are ignoring the psychology of trading or postponing investigating, the psychology of trading until they have a better handle on trading. It won't come unless you study, unless you put a little bit of emphasis on your inside, uh, the way you perceive problems, the way you perceive risk, be it money or crossing the street. It's in our mind. Trading takes place between our ears. That's it.
One of the things that I want to hear you talk about too is, I think the best way to scale up the strategy, the best way people are using it to make a good income out of it is with funded accounts, with prop firms. kind of walk you through how you kind of look at prop firms and what you use to be able to make decent returns with this kind of method?
So yeah, the returns, you basically are extracting from a 2-hour window, the same 2-hour window every day. And because it's starting from this consistent routine, 2 hours every day, the same 2 hours on the same instrument, after a little while, you start building this expectancy, right? You show up to work and you kind of know what you're in for. There's this oddball day once in a while where stuff doesn't work out as expected. That's what we're here for. We're managers of risk. But for the run of the mill, the 2-hour window delivers a run rate, a potential average yield, PAY. And we're aiming to extract in that neighborhood, that potential average yield, that paycheck on a regular basis. And so I make sure to say potential average yield. I spell it out because I don't want people falling into the trap thinking it's the same every day. Some days it's $50 and some days it's $1,000. That's what the market gave you as opportunities inside of that 2-hour window. So you're not creating trades that don't exist. You're just taking the trades that are there in that 2-hour window, and that potential average yield becomes, if you respect the 2-hour window, becomes a salary. And it's something you can therefore scale thereafter, right? You have to earn the right to grow bigger. So just because you made $1,000 doesn't give you the right to double the size of each click, right? So you have to respect the equity, and 0.25% of your equity will grow in due time. And so over the course of time, the potential average yield, which is a range, right? So it's a paycheck, but it's a range. You get a minimum pay and a maximum pay. Somewhere in there is your paycheck. This range is kind of what people. It's like a trip hazard, right? People start trading thinking I'm going to make $200 a day. They set this hard stone goal, and then they get really upset, pissed off, and angry when they can't reach it. So what I tell the guys to do is create a potential average yield, an environment that pays. And with that pay, you have an average. So now targeting anywhere from 80 to 150 or from 80 to 200 satisfies the goal, right? So instead of I must have 200, I now set myself up with I'll be happy if I make between 100 to 200. The psychology of having a range to work with instead of an absolute is tremendous when it comes to trading. You'll notice all I do is deal with ranges, right? A 1-minute candlestick is a range. It's inside of a standard range. I didn't make this up. It stopped here and turned around, right? The range inside of a range is inside of a bigger range, right? We are range traders, all of us, whether you like to admit it or not. We're all trading ranges, and if you don't like it, then switch over to a line chart. And you're still going to be trading ranges, right? The highs and the lows are still containing the ranges. So it doesn't really matter. The paycheck is extracted from that range. And then if you're a swing trader, your paycheck is coming from the expansion out of the ranges. That's it. I make my money from the ends of your swings.
So you've been trading a few funded accounts in the past. Do you find it more difficult or more like there's more pressure when you look at the funded account compared to your own account for this method?
With any method, I think it's the psychology of trading. Demo or funded makes really no difference. From a mechanical side, The only difference is the load on the server from the broker, right? The live server will have a fraction of the users that the demo server services, right? So there may be 100,000 users on the demo and there's 10 on the live. And so when the news comes out, you get the same prices on the chart, but it reacts differently, right? So it's still the same prices on the chart. Trading takes place inside your head. And so if you're having a problem trading a prop account, but you're making money with your own account, the problem is still psychology. You can adapt the strategy. You can make it work with different spreads, different commissions. You can fit the model to what you need. You can extract what you require from the market. It's hard to hear that, but trust me, you can. You can budget each one of those clicks. You can tell a month in advance how many clicks you need to pay for stuff. Right? That doesn't mean the market will give them to you.
So if people want to see more about how you trade and they want to actually join you and learn from you, we'll leave below the link for Elite Scalping, the program that you run at Desire Trade, where you go over your style, your strategy, your rules and details, and you trade live twice a week with people. So it's kind of cool to get behind the scenes on that and to be able to trade live with you. We'll have that link below. Anything else before we finish off you want to mention here?
Well, yeah, I trade live in front of the group on Tuesdays and Thursdays between 10 o'clock Eastern and 12 o'clock Eastern. I answer questions throughout the week in a Slack environment. And so feel free to come along and sign up. There's help there. And it's a community of like-minded traders. So we're all thinking in probabilities. And there are groups that deal with other strategies, but this particular thesis, this particular approach to managing risk is one of a kind, and I'm more than happy to share it.
Totally. We'll put a link below. You do some good work out there for sure. People can reach out to you and see the stuff you're doing there. And hopefully they can learn from you in the coming year. So I appreciate your time here, Jeff. It's been fun to chat. And hopefully, look forward to see how you do next year, which can be good for sure.